This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, JP Morgan's Bombshell news now sparks fear and uncertainty, and you're not going to believe what they just said and why it has such dire consequences for the U.S. economy. Plus, we're seeing renewed signs of deflation spread across the global economy, and now coming out of a country we were told this shouldn't happen. And if you're wondering what we're doing in Cushing, Oklahoma today, well, we're staring down at the bottom of a lot of empty tanks. And with that, let's over to Zero Hedge, where we picked today's story up with a headline: West Texas Immediate holds gains despite huge crude build. Production hits record high as Cushing tank bottoms loom. And this is a big problem because we're not supposed to see tanks getting to the bottom. What this usually tends to happen when we see that is you see prices go up. And I want you to be thinking right now of why rising prices for U.S. consumers could not come at a worse time. Because when you think about their budget, they've got rents that are finally starting to stabilize. They've got food, again, starting to stabilize. And we talked about this in the show the other day. In a matter of months, we should see that kind of normalize. But the problem, energy prices are looking to surge a whole lot higher. And as Bloomberg reports, global oil inventories are on track to decline by a whopping 3 million barrels a day in the final 3 months of the year. This according to the latest report from the OPEC, or Organization of Petroleum Exporting Countries. If realized, it would be the biggest shortfall in data extending back more than 3 decades. On the other side, the International Energy Agency said earlier on Thursday that there is evidence that the rally triggered demand destruction. And this is a case we're making, and we've been making, that consumers cannot afford higher energy prices. If they go higher, all of a sudden what you're going to see is a huge decline in demand. And now this coming from the IEA saying eroding gasoline deliveries in the U.S. to the lowest in 2 decades. That's staggering. Even emerging countries were hit harder as their currencies weakened, it said. And here we can look at this week's oil inventory report. Let's focus on the Department of Energy, because what we've been looking at last week, you may remember, gasoline inventories rose 6 million barrels, and that is outright staggering to see such a huge increase. So we mentioned last week that we're going to watch to see if we're going to continue to see build in the gasoline space. This week, we saw a decline of 1.3 million barrels. Even distillates were down 1.8 million barrels. But look at this, crude oil inventories up 10 million barrels. The problem here is Cushing, Oklahoma. Now, what happens there? Why do you see that that's an issue? Because, of course, that's where the type of crude goes that goes right into your gasoline and gets refined. So we see these barrels at the bottom of the tank, suggesting that perhaps crude oil prices are likely to rise. And, of course, if indeed the IEA is right, and we believe they are, that we're going to see further demand destruction, this is bad news for the U.S. economy. And here we can see the consumer price index is shown in blue, and against the crude oil prices. West Texas Intermediate, of course, the CPI is on a year-over-year rate of change, and crude oil prices are not. Because what I want you to see is during periods where you see rising inflation, and then you get a big surge in oil prices. Here you can see in the around 1990 to 1991, what happened? Demand destruction, and what notably followed is a collapse in the consumer price index. How about here, 1999, going into the early 2000s, what happens? Oil prices are rising, consumer prices going with it for whatever reason. And we'll show you here on the next slide what actually happened. All of a sudden you get demand destruction, and next thing you know, consumer prices come down. And it doesn't have to be, the energy part that brings the CPI down. If you have more of your budget going to energy, that is, again, comes back to less discretionary spending, and the next thing you know, you get a domino effect to the downside. How about during the global financial crisis, we saw inflation and crude oil just going through the roof, but next thing you know, they're both collapsing, one into outright deflation, that being, of course, the consumer price index. We see it happening again here, and you notice in 2012 to 2014, crude oil prices are rising, consumer prices are falling. What is that telling you? Demand destruction, and all of a sudden, consumers hit their breaking point. We see it again around 2019, and then we see it now. The difference is Everybody thinks that higher oil prices are going to drive inflation, and they can, but we think that that would be in a very short-term move because there will be so much other demand destruction, which is notably when we talk about what JP Morgan said today, what some of the other banks had to say, and why we're seeing deflation spreading around the world. It suggests that indeed demand destruction is real. And the evidence of that is very simple. We take a look at total compensation. This is your average weekly hours multiplied by average hourly earnings of production and non-supervisory employees, shown in blue on a year-over-year rate of change, keeping West Texas Intermediate constant in our chart. Now, why would we do that? It's very simple. Is if you see energy prices rising and you're not seeing total compensation go up, what does it tell you is that consumers can't afford it. And if they can't afford higher energy prices, and we know they have to pay for it, that means other money gets redirected out of other spending, and next thing you know, the economy slows, we see higher unemployment, we see consumer prices come down, it all feeds back on itself. And sure enough, you go back to 1991, what happened? You see total compensation slowing down, oil prices spike, breaks the back of the consumer. How about here around 2001? You notice oil prices are rising, and we see, of course, wages going up. This means the economy is handling it, consumers are handling it. Next thing you know, total compensation starts to go down, and then crude oil prices go with it. How about here? In the global financial crisis, in the early stages, it looked good. While oil prices were going up, total compensation was outpacing it. All of a sudden, consumers get used to that higher wages. Next thing you know, it slows down. Oil prices don't, and the whole thing comes unwound. The same thing true around 2014. Total compensation just not growing fast enough to support higher energy prices. How about the same event in 2019? And you're seeing it again now. So you notice a trend. Total compensation is heading lower as energy prices spiked up. You see that here in early 2022. What happened then? They came collapsing down because consumers couldn't afford them. Now the belief is because OPEC is going to cut production, that's going to drive oil prices higher, and it will in the short term. The problem is there's going to be so much demand destruction, which is why we're going to be very key to be following these weekly inventory reports going forward just to see how consumers are handling this, because if we see more demand destruction happening, well, it tells us the likelihood of a recession is soon. And now let's head over to China, because what's going on here? They're on the brink of deflation again as they reveal a still weak rebound. Now, you may recall, when we talk about China, they were supposed to have this soft landing. They thought they had to figure it out. The world said, look, their manufacturing sector is rebounding. And we said, don't buy into that narrative. It's all holiday seasonal stuff. It's all back to school stuff. When that goes away, you watch, things are going to roll over and head down. And sure enough, the data on Friday was mixed as consumer prices unexpectedly slowed to a brink of deflation in September. I love the word unexpectedly here, as concerns linger about weak demand. Well, we've told you that was actually real. A slump in the nation's exports have moderated, though consistent growth remains elusive for what once was a key driver for the world's second largest economy. And while new credit jumped last month, the amount of loans made missed expectations. So here again, you see Chinese consumers not buying into the whole narrative. They're seeing a slowdown in their work, and they know that means the rest of the world is slowing down. And so in turn, what do people do when they think the world is slowing down? There's going to be a recession. They pay off debt, they save money, and they cut back spending. And now you're seeing it all happening right there. And after alarming slowdown activity over the summer, some parts of the economy began showing signs of improvement. Yes, there was hope in the factory sector, and that sparked some cautious optimism, well, not from me, of course, about whether China had moved past the worst of this year. The manufacturing sector improved, and credit recorded bumper growth in August as Friday's trade data for September, while still in contraction. So here you can see global economy still contracting, suggested that global demand for Chinese-made goods is improving. We said it was all seasonal, all transitory, and now we're starting to get some evidence that indeed it is. As deflationary pressure in China is still a real risk to the economy, the recovery of domestic demand is not strong, and without a significant boost from fiscal support, it's unlikely to be strong. And so here again, we come back to the Chinese consumer. They're saying, look, we don't buy into this recovery. We don't believe the central bankers can engineer a soft landing, because when we go to work, we're not seeing the new orders that we would need to see to validate the economy is expanding here. And sure enough, all that means is they're going to cut their spending, and that's going to force Beijing to do the unthinkable. As China moves to add fiscal stimulus space after weak data. Now, we do happen to know that China does not like doing fiscal stimulus in the traditional sense like we do here in America. But what happens, I want you to be thinking, when countries do fiscal stimulus, particularly a country like China, what happens to the value of their currency? You're right, if you said the yuan probably going down in value, well, what does that mean? The dollar likely to go higher. And of course, you would know about that trade because we've been talking about on the show how to use our CTA-Timer Pro, a machine mimicking report. Looks how the machines are positioned in the market, tells you when they reach extremes, tells you when they're short covering. Here you can see on this red candlestick, our machine positioning told you this is where you want to buy. Then you can validate it with our Momentum Timer Pro report. If you did, you would have caught this dollar trade and been up 6.3% so far, and maybe even more. Let's take you back to July 25th. Here you can see on the report covering on the deep short positions on UUP. There was your first signal. The second signal came a day later on Momentum Timer Pro. Here you can see that one-day buying signal. You can use one report, or as many of our successful traders do, they pair them together. When they see confirming signals, they buy. There it is. Look today. Now, this is from today's report. This is how easy it is to use. You get those confirming signals. You put your trade in. Add a stop loss, hopefully. And here you can see we're still a little bit of pullback on the machine positioning, suggesting tighten up your stops or maybe switch to a trailing stop order, because on the momentum signal is still strong, not confirming you need to get out. And that's how easy it is to use our reports, my friends. There are links in the description below, and there's a limited number of coupons still left for that free month on Momentum Timer Pro. Check them out. It'll change how you trade and maybe change things for China. As a standing committee of the National People's Congress and the Communist Party-controlled parliament that oversees government borrowing will meet later this month to review a bill assigning additional local government debt quotas in advance. And that means, of course, when you have a quota for debt, that means you have to borrow more money. Can you imagine that? Could you imagine going, having a household meeting and say, well, we didn't hit our quota for how much money we borrowed this month. We need to borrow more. And that just doesn't bode well. But that's how China does stimulus. They put out at the local government level and say, look, you need to raise your quotas up. You need to borrow this money. And where is that money going out to? Well, it goes out in stimulus. An economist said such a move could boost government spending. Well, it's obvious. If you raise their quotas, they're going to spend more later this year or in early 2024, as China's previously let local governments issue bonds in January and February ahead of the government's budget, which sets debt issuance limits for the local authorities and usually is approved in March. So what we're seeing here is a slowdown there is making them desperate. And then when you start paring this back, you look at the crude oil data. We see demand destruction. Wait till you see what Jamie Dimon said from JP Morgan and what's been happening at the other major banks, because it's a problem as we see the global economy continuing to slow. As China's export slump eases, as Beijing tries to boost the output, of course, we know that this is going to roll over and head to the downside, as overseas shipments fell 6.2% from a year ago, slower than the 8% decline forecast. Imports decreased 6.2%, down from 7 months in a row. And I want you to keep in mind, when you see exports and imports shrinking, it means the global economy is shrinking. It means the local economy is shrinking. We continue to see that, and it's mainly because all of this fiscal stimulus that was mainly pumped into the global economy by the U.S. is gone. And then on top of that, we know U.S. consumers now are facing student loan repayments resuming, higher minimum payments on their credit cards. It's just a perfect storm to see a slowdown, and we note it. It's coming out of China first. The upside surprise of trade data shows some short-term stabilization in the Chinese economy, according to the chief economist at Australia New Zealand Banking Group. However, China is still slowing down structurally, and a spike in the trade data will be short-lived, which is obvious because when banks tighten lending standards, and we're going to get into more of what the banks said and what they're doing, all it means is U.S. consumers, when they can't borrow and spend, that means the global economy slows, and that is a problem because we're there. As exports must go to major markets continue to fall, with shipments to the European Union down almost 12%, those to Asia falling 16%, and exports to the U.S., Japan, South Korea, and Taiwan all dropping. And imports from major commodity buyers such as Australia, Brazil, and Russia rose, while purchases from the U.S. from Japan and South Korea fell. And here you can see coming out of the U.S. data today, we have the export price index down 4.1% year over year. We see the month over month trend continuing to slow. Again, we're seeing export into deflation. We are exporting deflation here. How about the import price index down 1.7% year over year? Big drop from 3%. Again, we're seeing an improvement here, but we are importing deflation, and notably the import price index only up 0.1%. So we're exporting deflation, importing deflation. Now you might say, well, it's not as much deflation, Steve, so it's not as bad. It's improving. Well, got to remember, we saw this kind of resurgence here in the factory sector out of China due to the seasonal demand from the U.S. that's going away. Watch it turn around here. Because what's why it matters is when you look at the consumer price index that we'll hear from the Fed in November, in about 15 days, they're going to talk about how they are going to see inflation surge higher. But when you look at the import price index, what do you see here in red? They're on the same side. They're both on a year-over-year rate of change. Notably how the import price index goes down, and it puts downward pressure on the CPI, and it holds it down. It doesn't drag it down. It just holds it down like a weight around its neck. You see that here again in the dot-com bubble. How about the global financial crisis? Same effect. How about the global slowdown that almost was a global recession? 2015, 2016, same effect. Happened going into the pandemic. As we know, the global economy was once again slowing down. And here we can see it. Yes, it rebounded a little bit, but we are still importing deflation, and that weighs in on the consumer price index and consumer spending, because we're about to see consumer spending completely hit a wall. And now let's take a look at what the banks had to say, and then we're going to get to what Jamie Dimon said, and that is ominous. As Citigroup trading desk windfall drives higher than expected profit, that's the headline, but we don't care about that. We care about the details of what's going on with the consumer. And here you can see the CEO recently warned that the company is starting to see signs of stress among U.S. consumers with lower credit scores as inflation erodes pandemic-era savings. Now, you might remember in a recent show, we talked about how the lower-income people, they're having in the surveys, in the Fed survey, said, look, we're running out of money here. We can't get credit. And yes, now we're seeing it from the bank saying, yeah, that's a problem, but well, look how they're acting. They're saying it's not a big deal, but we know it is. The bank set aside $1.8 billion in provisions in the quarter, a 35% increase from a year earlier, which included a credit reserve build of $125 million as customers carried higher balances on cards. And of course, going into any recession, what happens? We have record amounts of debt. No surprise here. People build up a ton of debt, inflation hits, they borrow even more money to try to keep up with it, hoping to get ahead of the curve. The recession hits, and the next thing you know, they're in delinquency, they've lost their job, and on their way to default. And that's what the banks know. They know this is coming. But again, I want you to see they're acting like this is just no big deal. It will be. As Wells Fargo tops estimates and boosts their net income amount expense forecasts. And yes, but we don't care about that headline. We care about the details, as Wells Fargo reported a $1.2 billion provision for loan losses, less than expected, but get this, which included $333 million in the firm's allowance for credit losses. How about this? Primarily tied to office loans. Investors have been closely watching the commercial real estate space in recent months. Now we know Wells Fargo's exposed to that and concerned because they're increasing their loan loss provisions. This is money they have to take and set aside and put into reserve. They usually buy bonds with it, and they hope, of course, they don't need it. But if they do, well, they have to absorb those losses. Someone has to pay. But now let's take a look at what Jamie Dimon at JP Morgan just said, because it's going to spark fear and uncertainty. As JP Morgan notches another net interest income record, lifts guidance, but again, we don't care about this headlines. We're happy the banks are doing well because they're not going to be doing well a whole lot longer. And we acknowledge that these results benefit from our over-earning on both net interest income and below normal credit losses. Both will normalize over time. So notice here you have that. They know they're tightening lending standards. We've showed you that when banks tighten lending standards, there's less money created in the economy, less new loans, and eventually there isn't enough money to support the growth of the economy and pay all the debt. They know this. So he's acting like, hey, look, it's just normal levels now. It's no big deal. It is a huge deal. The CEO warned that the wars in Ukraine and the Middle East could have far-reaching consequences. Quote, here it is, this may be the most dangerous time the world has seen in decades. Can you imagine now that's coming out of the head of one of the largest banks, if not the largest bank in our country, saying we are facing dark times ahead, and this is a problem because the last thing we need is uncertainty. They said total loans rose 18% from a year earlier as deposits fell 1%. But how about this? The lender reported $1.5 billion in net charge-offs, citing credit card loans for the increase. Dimon said last month that higher card losses are, quote, normalization. Yeah, we'll see about that. From exceptionally low levels in recent years, and this firm has been over-earning on credit as JP Morgan reduced the pile of money set aside for potentially soured loans by a mere $113 million, while analysts expected a reserve build. This is very arrogant. We see by, of course, this huge bank suggesting that this is just normalization. We know it's going to get worse and a whole lot quicker, and that will set off what is likely to be not just a recession, not just a global recession, but an all-out global financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.